Hey guys, welcome back to another video. If you're new to my channel, hi, my name is Miranda and I teach about anything and everything related to the trucking industry and how to navigate it. So if this is a topic that interests you, feel free to subscribe down below. Guys, I just did something that I think will be really exciting for so many of you. I just purchased a subscription to FreightWaves SONAR. Now, if you don't know what SONAR is, this is a tool that provides in-depth market data for the trucking industry. A few days ago, I was trying to make a market update video and I realized that I am severely lacking data because all the data that I needed was locked away either under SONAR or ACT Research and so on. So I decided, you know what, I'm just gonna bite the bullet. I'm going to get that SONAR subscription so that I have access to all the market data to understand what exactly is shaping our industry. And thankfully, the team at FreightWaves was kind enough to allow me to use that data as a visual aid to share those updates and insights with you guys. I'm super excited and I have been nerding out big time ever since I got access to this data. So today we're going to start with something easy to understand and something that you can actually apply to your operations right away. We're going to look at how loads end up on the load board, the spot market, the importance of tender rejections, and where you can find the best opportunities to make money right now. Ready? Let's go! As many of you guys know, and something that I only recently learned myself because I have been living under a rock, tender rejection rates are extremely important to understand which way the spot market will go. So what does that mean? Well, to understand tender rejections and their importance, what we're going to look at is how do loads actually end up on the spot market or on the load board that most of us use? Through an annual bidding process called the request for proposal, shippers will offer their predicted shipping volume to a network of carriers. And drivers who are interested in that lane will give bids. Now, once a carrier wins a bid on a certain lane, it becomes a contract rate or a long-term agreement locking in the price and the shipping volume. And this is a great way for both shippers and carriers to have a little bit more stability and predictability. Shippers can now estimate the cost of transportation because they have some contract rates locked in, and carriers can now feel safer because they know they will always have work available. But like everything else in this world, this can change. Even though the term contract suggests something legally binding, contract rates are really not legally binding at all. Sometimes people refer to them as paper rates because these contract rates are only good on paper and can change depending on the market situation. Now, something that you should keep in mind. During the initial bidding process, the rates that carriers will give will usually be based on current market conditions. So for example, in 2021, the average rate per mile for a reefer in December, let's say, was over $3. So that means that those carriers who were bidding on contract lanes in December of 2021 were bidding based off the current market situation where rates were over $3. Now 2022 rolls around and the spot market crashes. But those with contract rates are making more money than those who work off the spot market. Why is that? Well, because those contract carriers put in their bids when the market was still good. And contract rates, while they follow the spot market, they lag by a few months. On the flip side, if the market is as bad as it is in 2022, contract carriers will start bidding lower, of course, than they did in 2021. But the question is, what will happen if in 2023, let's say the market starts booming again and the spot rates are much higher than the contract rates? Well, the contracted carriers will start rejecting their contract rates and turning to the spot market. After all, everybody wants to make money, right? And the thing is, as contract freight is rejected, guess where it ends up? It ends up on our load board on the spot market. So here is the first chart I want to share with you from FreightWaves SONAR. And what we're looking at is we're looking at the 7-day average of dry van spot rates versus contract rates. So the blue right here, these are spot rates. And this starts from August of 2021 all the way until right now. Now, this line, the green line, are the contract rates for the dry vans. So what do we see here? You can see that the spot rates were way higher than the contract rates. What does it mean? It means that contract carriers felt like they were missing out, and they rejected their contract rates in order to make more money on the spot market. But once that contract freight was rejected, it ended up on the spot market increasing freight volume. Now let me show you a different chart. This one is the outbound tender rejection index, and this is from August 2021 all the way until right now. As you can see, tender rejection rates started falling dramatically from the end of February of 2022. And guess what? I'm going to zoom out a little bit so you guys can see this. As tender rejection started falling, so did the spot rates. See, the blue is the spot rates. They started falling as well. Why is that? Well, because again, when contract freight gets rejected, it ends up on the spot market. So as carriers stopped rejecting their contract freight, less loads ended up on the spot market. And if there are less loads on the spot market, that means that the spot rates start to get pushed down. Now, the thing is, the spot rates are also pushing the contract rates down. Again, the contract rates in green, they are lagging because they're a few months behind the spot rates. But as the spot rates start going down, so do the contract rates. So basically, this is a downward pressure on all sides until enough capacity leaves the market. Now, as you can see here, we're getting pretty close in terms of dry vans. The contract rate is averaging around $2.64. The spot market is $2.59. It did have a little bit of a jump in November. I felt it. So there's not a huge difference in rates here. Another thing I want to show you is the rejection rate currently. It is at 4.1%. So pretty low. But there is a little note I want to make here. As we all know, carriers who primarily use the load board, work off the spot market, are starting to shut their doors. But what about contract carriers? Well, many of them are still making way more than what the spot market gives because they negotiated their contract rates when the market was still decent. Now, the big question is, what will happen when the annual bidding process begins again and those contracts have to be renewed? Well, as I mentioned before, contract rates mimic the spot market. So as contract rates starts mimicking the spot market and possibly even going below the spot market price, there is a chance that contract carriers will also start leaving the oversaturated marketplace. It's a sad reality, but this is how it has always been. Now for the super interesting part, it's time to look at where you should go to get a better opportunity in terms of loads. Now, a quick note about this, the FreightWaves SONAR map that I'm about to show you, unfortunately, is only available for vans and reefers at this time. But once they add flatbeds to the mix, I will definitely be sharing that as well. So let's take a look at vans. If you're looking at this and thinking, what in the 3D Minecraft looking thing is this? I'm going to tell you this is the most amazing market map I have ever seen. Anyway, let's take a look. This is for dry vans. So if you look at this, you'll see there are different colors here, but there are also elevations. For example, you can see that here, Atlanta, Georgia, right here is extremely elevated. Florida is pretty elevated. The Detroit, Michigan area is elevated. So what does this all mean? Well, the elevation levels refer to how much volume there is in the market. And the way it is measured is how many tenders or rate confirmations have been sent over the past 7 days. So for example, we can see that in Atlanta, right here, there is a ton of volume. There's a ton of loads here. Then if we look somewhere like Indiana, there's also a good amount of volume. Let's take a look at California. You can see in California, there's a good amount of volume. There is a lot of freight. But the thing is, now we have to consider the colored portions of the map. What do they mean? Well, the darker blue an area is, the higher the tender rejection rate over the past 7 days. So for example, right here, this area of Nebraska, it's extremely dark blue, which means that a ton of tender rejections are happening. And as we already learned, if a load is rejected on the contract market, it ends up on the spot market. And there's a strong correlation between tender rejection rates and spot market rates. The higher the tender rejection index, the higher the spot market rate. So we can assume that the darker blue areas have high paying loads. Now, the best part about this map, Since it measures tender rejection rates, we can look into the future a couple of days. Why? Because the contract freight that gets rejected might only trickle down to the spot market in 3 to 5 days from now, sometimes a week. So we are kind of looking into the future here. So let's look at an example for dry vans, right? Here is the Colorado area, the Denver, Colorado area. What can I say about it? Well, not only is there a good amount of freight, a good amount of volume, and this is surprising because usually Denver, Colorado is not a good market. The tender rejection rate is also pretty high. It's pretty blue here, which means that in a few days from now, we can expect the rate per mile from Denver, Colorado for dry vans to increase. Now let's look at the Atlanta market because this is the most elevated market out there. There is a ton of volume in the Atlanta market, but as you can see, it's extremely light, which means that the tender rejections are close to zero. Basically, this is the type of market that has a ton of loads on the load board, but nothing to really choose from because the rates are so bad. And this is because the tender rejection index is pretty low. So what about, let's say, a place like, I don't know, let's say Omaha, Nebraska, which is right here. Well, we can see that the tender rejection rate is extremely high, but the volume is really low. And that is true. It's also true of markets like Iowa and Minnesota for reefers is usually like this. There is not a ton of freight to choose from, but the rate per mile is extremely high. So now I'm going to zoom out of this so that you guys, if you're interested, if you have a dry van, just take a quick screenshot of this so that you can plan your next operations. Now let's look at the reefer map. Here is our reefer map. Wowza, it is not a good map at all. Why? Well, because we can see a ton of flat surfaces that are completely light, which means that there is no volume and not a high tender rejection rate. So for example, Colorado, New Mexico, most of Arizona, Nevada, Oregon, Montana, of course, half of South Dakota, all of these areas right here, even Texas. You can see that these areas are not only flat, but the tender rejection rate is also very low, which means that no loads to choose from. And if there is a load, it's going to be paying pennies. But look at areas like Utah right here, Idaho, some of Washington. There is also Missouri, of course. Well, in these states, there's not only high volume, but there is also a high tender rejection rate, which means that you're going to have a blast if you go here with a reefer. You're going to have a ton of loads to choose from, and they will be paying pretty decent. Then we see a place like this right here, which covers some of South Dakota and some of Minnesota. Not a ton of volume, but the tender rejection rate is really high. As I always say, Minnesota is one of the best places you can end up with a reefer because there are not going to be a lot of loads. But you can basically close your eyes, point to the load board, and you're going to get a load for $3 per mile. But now let's compare it to a place like Florida or right here, the Fort Worth area in Texas. Well, there is a ton of volume, which is true. I was very surprised a few days ago. In Dallas, there is a ton of volume, but the rates are not that great at all. Same for Florida. There's a lot of freight right now, but of course it doesn't pay anything. So now I'm going to delete all of these markings and I will let you guys take a screenshot in case you have a reefer so you can also plan for future operations. Anyway, guys, I hope you enjoyed this video. I hope you learned something new for yourself. I am really excited to have sonar in my toolbox now. I have so many ideas now, and I really hope that this system, this sonar system, will help me and you guys streamline operations and have a bit more control in the current market situation. Anyways, I hope you guys have a wonderful rest of your weekend, and I'll see you in the next video.